We need to create 4.3 million more rental units in this country by 2035.
Hello, everyone, and welcome to Housing Insiders, the podcast for founders, builders, lenders, and regulators, and anyone who believes that everyone should be well housed. I'm Jonathan Lawless.
And I'm Jeremy Potter. On Housing Insiders, we're hosting the conversations you won't hear anywhere else about how to make housing more innovative and attainable.
And of course, a thanks to Built Rewards for sponsoring all these smart conversations, but we're always on the lookout for new sponsors or topics. So if you have ideas, please email us at podcasts@thehousinginsiders.com.
And if you like the show, please give us a review, spread the word, share our episodes, because that's how we get to make this episode and many, many more to come.
All right. I'm super excited about today's episode. We've often talked a lot about housing finance, and the single family market's always one that's fun to talk about. And Jeremy and I have shared background in that. But today we're going to get to talk about multifamily a lot. And we've got Bob Pinnegar joining us, the president and CEO of the National Apartments Association, really, really important organization. He joins us today to talk about what's going on, the new administration, the changing economic landscape, what it all means for multifamily industry and for rental housing providers.
Welcome to Housing Insiders, Bob. For starters, I was hoping you could tell our listeners more about the National Apartment Association, who it represents, and what you do.
Well, we're what's called an old-fashioned trade association. So you join at the local level, and that membership rises up through your local association to your state association to us. So we have 141 affiliates across the country through which our memberships come through, and also our volunteers as well. So nationwide, we have 95,000 members, about 12.2 million units in membership. And we're the big tent. So it's every niche you could imagine within the rental housing industry. They're here in some shape or form. And as a result, we've created products and services to meet the needs of many of those different niche groups, as well as conventional housing overall.
One of the things that we like to say here is everyone well housed makes for a better economy, housing ecosystem. And so what you do is a huge, huge part of that. But it sounds like you face a lot of the same complexities where you have a individual rental unit owner who has concerns and they have issues that they want you to represent. And then you have property managers and apartment building owners and operators that have hundreds and as you said, millions of units that they have concerns. So how do you talk about the state of rental housing with that complexity? How do you think about it? How do you talk about it with those sides, those bookends?
It's sort of like, I guess it would be a mutual fund that holds many different types of stocks, and you're really looking at the larger trends. When you look at the national trends, you need to really understand and acknowledge that every market is unique. And so while you may see things that are happening overall, there may always be differences that are going on in one market to another, in one niche to another. Those are definitely challenges we're seeing. And if you look at the current condition of the market now, where we have a oversupply that's been talked about much through 2024 as a result of the delivery of product, some of which was pre-COVID that got delayed as it was going through delivery, and then others that were scheduled for delivery. There's some people that are really hurting, and there's been a lot of documentation about that. But then there's other parts of the country that have been relatively untouched from new supply coming in. While it's not easy to talk about things in generalization, you need to always acknowledge that there's differences out there. And we have research that we do. There's other groups that do research that I look at, and I'm always looking at the sub-market breakdown and what does that look like overall.
Just I guess a practical question. Do people call you guys NAA or NAA, or is there a shorthand that you guys prefer?
Usually it's NAA. This industry and acronyms, they love them. And if you don't know the acronyms, it's a very difficult introduction into it.
Of course. So at NAA, can you give me a sense of some of those submarkets? And then maybe I'll just give you a question which to talk through it. So you're in the DC area like I am, and it's I think for many people, it's hard to look away from all the insanity that's happening in the city. Some are looking at it with terror and some are looking at it with joy and excitement. But regardless of how you're looking at it, it's it's impacting the economy in a lot of different ways. So maybe let's just take sort of inflation slash tariffs and the possibility of prices going up, and then maybe sort of how do you think about that affecting the cross section of different organizations that you work with, maybe as an example issue.
A lot of people right now are looking at what's going on and making straight line predictions, and the world seldom works in straight lines, usually is a circuitous route to get there. So I think we're going to be somewhere in the middle of what's being discussed. But looking at the industry and looking at the segments, also I've been looking at some of the projections by some of the economists out there. Yes, there's the possibility that we could go into a recession that would have an impact on demand for housing. At this point in time, based upon the recent information we've seen from the first quarter of this year, we are seeing absorption in those markets where there was an excess supply. And while many people had the mantra stay alive till 25, once they got to 25, there was the acknowledgement that it's going to be another year before they start to see absorption in those markets. The Austins of the world that are extremely oversupplied is going to take longer. There's some markets in Florida that are going to probably take into 26 and maybe even to 27 by some of the doom and gloom predictors out there. But I think that at this point we're seeing absorption. There is a real possibility that if there is a recession that occurs, that could impact that path to absorption. Because let's face it, during every cycle when this happens, household formation is impacted when you have a recession. So that means the studio and one bedrooms are less attractive. People are going to look for roommates to move into a two-bedroom unit or move home, if that is an option for them as well. And so that has happened to us over the years, and that could happen. But given the supply and demand imbalance that we have in this country, it's difficult to say, is that going to be the case, which has happened in previous recessions? Because we also are in a situation where we have high interest rates. The housing ladder is, I won't say the rung is broken for first time homeownership, but it's a very difficult small rung to get your foot on to go up to that next level. So that is creating an environment where more people are in housing longer before they can transition to that first home they purchase, whether it be a condo or a single family home. If I had a crystal ball, I could give you a lot more information. But there's just a lot of conflicts that are going on right now in the environment. And through that same space, you're also looking at various niches. You have senior housing, which has been performing very well because we have baby boomers that most of their wealth has been in that asset as their home. They've been selling that, liquidating that asset, and then using that to be able to plan what lifestyle they want to have. That's been a niche that's been performing very well. Market rate has been performing well. The build to rent space is something that there was a lot of discussion of where that was going, and there were some very big predictions that were pre-COVID. But the interest rates, I think, are really slowing that process down. But I fully expect that given the challenges we have with people moving out of rental housing, we're going to see that segment mature in a much faster way than, say, the student housing space did, where it took decades for student housing to mature. I think the build to rent space is going to mature in a matter of years, not decades.
Yeah, the comment you made about the starter home, I've actually written the obituary of the starter home, claiming that it is no longer a part of the housing ladder. And so I think that the housing ladder is a great way to put it, because one of the things that home ownership, the mortgage industry, for instance, counts on is that move up and downsize trend. And so what you're saying is one of the niches seems to be you've got all this equity now sitting with the homeowner, less of an incentive to downsize. And so those homes just don't open up with any regularity. And if they do, it sounds like what you're saying, but I want to confirm this, is like they may actually open up through the former owner renting it out instead of actually putting it back on the market. Is that one of the implications you were talking about with that niche? I want to dig in a little bit more to the downsize trend that has changed.
Given the record low interest rates we had for the last several years, that is a real possibility, because if you've had the home for a period of time, you have significant equity in it, you have the ability to rent it out. So it's not just I need to sell this asset in order for me to attain my lifestyle. I can rent that product out, and then I can have an income stream from that that is going to maintain me, indefinitely going forward. So, that's the old independent rental owner, which is really the underpinnings of this industry. If you look at rental housing overall, there's what, 43 million units and change. In the communities with 5 units or more, you're probably talking about 19 to 20 million units. You're talking about somewhere in the neighborhood of 22 to 23 million units in the 1 to 4 unit category. And so that independent rental owner segment is huge. And that shadow, and many refer to it as the shadow market. That has great impacts on the industry, because if you have a single family home that you're going to be renting out, you're not going to be necessarily renting that at a price point that is going to be the height of the market. You want somebody who's going to be in there and be there for a period of time, because you don't want to have a turnover for 5 or 6 years. And those different objectives with regards to how the investor is going to be maximizing that asset, which has an impact up and down the food chain with regards to other products.
I'm going to pivot a little bit, but just only because there's so many things that you said that are so fascinating. In the single family space, we talk a lot of time, almost exclusively, about the lack of housing supply. The apartment and multifamily world has gone through a different dynamic. Can you talk about what the supply dynamics have looked like in multifamily, and are there markets that still are seeing constraints on creation of supply that really need it, or is that less common, like it is in the single family space?
Well, I mean, we've done research ourselves with the National Multi-Housing Council that really highlights the fact we need to create 4.3 million more rental units in this country by 2035 just to keep up with the current supply demand imbalance. The answer is yes, we do need to create more housing. And the challenge we have is we have a very decentralized decision making process where there are a lot of conversations. The previous administration, presidential administration, was having conversations about what they wanted to do to incentivize new construction across everything from single family home ownership all the way to rental housing. The current administration is doing the same thing, but nobody has complete control of this process. And so there may be incentives that the federal government can provide, but it really comes down to local zoning. In California, we've seen where the state has stepped in and mandated certain things of local jurisdictions. And there's been some movement there with creating more product, but a whole lot of backlash. I mean, I travel the country and I watch the local news about this development or that development. And there always is a predisposition of those that are in the community don't want to see anything change. They want it to remain exactly the same. And that is just not the case in many parts of the country. You need to have more housing, or you're going to choke off the economy of the local jurisdiction and end up with a Coke bottle economy where you have people at the upper end, which have an incredible amount of affluence, and people at the lower end that are struggling to survive and can't find housing. And those people in the middle have moved elsewhere because they can't make ends meet.
So one of the keys to that is really the cost, and we're talking about the cost there to the middle market resident tenant. There's also the cost of regulation. You've written a lot about regulations increasing cost to bring those units online. Can you talk about the two sides of this coin? Because John and I talk a lot about incentives being on one side and regulation being on the other. And you mentioned the incentives that, especially at the federal level, they're thinking about trying to get these units into the market. And then there's also the cost of regulation. And maybe you could tell us a little bit about that balance and how you're addressing some of those regulatory costs.
The current environment we're in, nobody intended to create this environment, but there were a lot of well-intended policy decisions that have been made over the last 30 years that have put us in the position we're in with regards to the zoning of land and how that is set up. I mean, what is it? 75% of the land in this country is not zoned that you could have multifamily housing in it. And that is a real problem. If you want to house people at scale, multifamily needs to be part of that solution, but there needs to be adequate policies in place to create product at all price points, because, market rate serves a segment. Back in the old days, which is before my time, but when talking with developers, you used to see A product and B product that was developed. The economics of today is that you can only develop a product because otherwise it doesn't pencil. Now, there is that trickle down to B to C, but that is a much slower process to build new product. And so we need to get to a point where we look at reducing those regulatory barriers, much of which is the cost of land because of the limited nature of land out there. If you're looking at raw land, it's less expensive to develop. But if you're looking at infill housing, you're going to have to scrape the land and then prepare it to build. If you're, and many people are talking about conversion of office to residential, you're literally looking for a needle in a haystack if you're looking for those buildings, because anything built after the 1960s tends to have a larger floor plate, so that doesn't work. The older product, it really depends upon the infrastructure that is not only in the building itself, but what is servicing the building. And let's not even talk about the issue of food deserts and amenities that people want to have around where they live. And if you're in the middle of a dense downtown office environment, you may not have those things. And so is that going to be compelling for somebody to want to move in there? That's a conversation that, we mentioned that, two of us are in the DC market. That is a conversation with downtown DC now, because while the mayor wants to convert these buildings into residential, those services of parks and schools and grocery stores aren't necessarily in close enough proximity to make that work.
Yeah, I think a lot of people are okay working where they live, but living where they work also feels very odd. Yeah, I agree with you on that trend. I mean, in response to that, I mean, what can multifamily developers do? I mean, obviously you can advocate for zoning reform, but are you seeing any innovations or any creative solutions to being able to create supply in sort of supply starved markets?
I know a lot of people on the operations side, I mean, mixed use is a challenge to manage because there are so many different pieces to it. But mixed use development has been the tool in many communities to be able to bring multifamily to the table, and in a way that it creates a sense of a community. If you look at Gen Z, they don't necessarily want the dense downtown environment. They're looking for that suburban urban feel. So creating those nodes of multifamily housing that have a concentration of retail and restaurants and other amenities, I mean, those have been quite popular across the country, actually.
When you think about the trends that affect how some of those members of NAA do make these decisions and try to build or frame up for their exact community, for the people that you just mentioned, I'm curious if you're seeing any trends that are different among that kind of first job entry level apartment, the Gen Z cohort, around particularly like luxury amenities. You mentioned the suburban urban feel. Does that also have a geographic impact too, or is it still in the same places that young people go to live? And how do your members look at that?
It tends to be on the fringes of the downtown areas where you see that begin to evolve, and really take hold. You see that here in this market. I've seen it in other markets across the country. From the standpoint of looking at it from a development standpoint, yes, you want to do that, but there's also a number of factors. Type of construction is going to be a big issue. I mean, if you're going to be doing concrete with a wood over the top, it's going to be a less dense product, which is easier to build, but is not going to necessarily always lend itself to that kind of environment that you're talking about, where you have this suburban urban feel. So then you're talking about steel construction, which is a different cost point, a different level of what needs to pencil to make that work. Factor into that right now the uncertainty over tariffs with regards to where are we going to get these products, the raw materials, what is the cost going to be for that? We don't know. It's not as much of an issue right now because of the conditions in the market with the excess supply. We've seen significant drops in new permits and we've seen significant drops in new starts. But as we get into 26, that's when it's going to become much more of a critical issue. And if we see that inflation takes a hold as a result of these tariffs, we're likely not going to see a reduction in interest rates. That's also going to be another barrier to seeing new construction happening in a meaningful way. And so there's a lot of uncertainty right now that it's my hope by the time we get to late summer, we're going to have some sort of clarity as to what is the direction things are going to be going, and the economy. And you're seeing disruptions in the stock market right now because there's uncertainty. I think that at the beginning of the year, somebody asked me, "What is the year going to hold?" And I said, "I'll have a better idea by the time we get to March." I do have a better idea, but to have any certainty, I think we're going to have to look at September before we have some certainty as to where we're going over the next couple of years. It's more of a news at 11. But I think there are a lot of factors that are going to be challenges for new developers and bring product forward, in addition to the age-old ones of approval through local jurisdictions and all those sort of things. And one of the things we haven't talked about is environmental issues. If you look at what's been going on with insurance rates, you're seeing areas that are more environmentally sensitive, where it tends to be coastal areas and other areas that are proximate to where people want to retire or want to live or want to vacation. You're seeing values go up substantially in those areas. You're seeing natural disasters occur. And as a result of that, you're seeing interest rates go up. For newer product, it tends to be easier to get insurance, but for older product, it can be very difficult to get insurance, and what you can get is very expensive.
We're going to take a break to hear from a sponsor who you know well, Built Rewards, and thanks for your partnership. I'm sure the team is excited to hear your voice. And when we come back, we're going to talk a little bit about some of the things that we can do to actively change policy and technology to kind of address some of the challenges. So let's take a quick break. Built Rewards is a payment platform for housing that rewards members in their home and neighborhood. Built is the payment platform for over 5 million units because Built provides incredible value to residents and to property owners and managers that use it. Properties using Built have seen reduced turnover, increased usage of electronic payments, and fewer missed payments. And with our latest resident loyalty program, Built is changing the way that property managers can reward good behavior. Managers can assign rewards and benefits to tenants for a variety of activities like early lease renewal. If you're interested in learning more, go to alliance.builtrewards.com.
Welcome back to Housing Insiders. Bob, when we left before the break, you were mentioning about this balance between cost and affordability and location, and particularly how climate and other things are, playing a role there. And one of the things that John and I talk about a lot are any of these pressures going to drive larger trends around location? And I'm also going to make this personal for just a second. I'm based in Detroit, Michigan. And so we're looking at this idea of how do you balance or boost really access and affordability, but then also maybe become a draw for people. So before we get into the policies, which we will in a second, that boost affordability and access, I'm curious if you have a sense of the willingness for private market pressures like insurance or jobs or the ability to have an affordable rental unit driving younger people to new places that they maybe didn't go before, or even that retirement generation that you mentioned thinking about different places. And is that something where just you think people would move to be more affordable, especially if there's a sustainability aspect, or is that too far in the future still?
I think there is a segment that has definitely been looking at where do they go from the standpoint of where can I afford to live? Can I get a job that is going to be able to give me some level of income that I am comfortable with, and where can I afford to live? If you look at the lists of where groups are moving, that has changed from when the millennial generation was all we talked about to now talking about Gen Z. And so I think that consumer demand is going to drive this in many ways. Also, from the investment side, I was at a meeting once a year. All the real estate groups get together and have conversations, and there was the CEO of AFIRE, which is a foreign investment group, and they had just recently done some research, and he was making the case that many foreign investors, which are much more sensitive to environmental concerns, when they're investing in the US, they're increasingly going to be looking at environmental factors as to where they put their dollars. So this may mean that they're going to be less invested in the Southeast and shift their dollars north because they're looking at things like availability of water. They're looking at what the temperatures are. Now, we had this conversation and he said some very interesting things and he was very passionate about it. Then winter hit and I saw it was 23 degrees below zero in northern Minnesota. I think there's going to be some factors there because people are going to take that into concern. But I think that we could see areas like southern Michigan and from down to the southeast. I could think we could see activity in those areas. I mean, we've long been seeing a robust revival in areas like Pittsburgh, which was a city that was laid waste when the Rust Belt actually occurred. But there's been a lot of regeneration going on there and interest in markets like that. I think that in those parts of the country, I think we are going to see a reexamining of what priorities are and where people want to be.
It's music to our ears. We started referring it to the Lakes Belt, and Ohio, Michigan, all high quality, low climate risk. Also, where Jeremy and I are from. Let's pivot a little to policy solutions. This administration, hate it or love it, seems to be a lot more willing to break some eggs in the course of trying to complete a recipe, and have also, I think, have a significant stake in seeing things like inflation be lowered. A big part of which, if you look at a lot of the voter records and surveys, a big part of that is rents. And so, you've got an administration that seems to need to put a priority on lowering rents, lowering inflation. And so I guess with that potential willingness to take some risks in that regard, what are the policy? I mean, my guess is you guys are not worried about the federal government doing rent control anymore, which probably was an issue in the last administration. But in this administration, where are the places that you guys see opportunity to kind of lean in that will be really helpful to, lowering rents and creating more multifamily housing?
Deregulation is a key area to take a look at. And so we've been actually having conversations with congressional leaders as well as the White House around deregulation, and they are all very receptive to the idea. We've been trying for I don't know 3-4 sessions of Congress to get regulatory reform around Section 8 because that is the nation's largest program to assist people that are in need, but it was created in the early 70s, late 60s, early 70s, and it looks at the industry from the lens of that period of time. And so there's a lot of things that can be done with regards to streamlining programs like that and many others to make them truly function in more of a market-like way and acknowledge that there are players out there that could potentially be fast-tracked. I mean, if whether you have CLEAR or TSA, when you go through an airport line, they're set up on the assumption that you are a good player and you're playing by the rules. If we had something along the lines of that we could develop for this industry around things like Section 8 vouchers, it would be a game changer. And so instead of looking at punitive things where you're forcing operators to take on the burden of the program and all the paperwork with it, the delay in inspections, so you may not be able to rent a unit for a month and you have lost income associated with that, to be able to streamline that, which would be huge. So we're looking at a lot of regulatory reform. There's the incentives. I mean, the administration had announced that they wanted to use federal lands for housing, and I think that this administration, because the president did come from real estate, understands that land is a very important part of it. The indications that we've gotten from the White House is that this is going to be a tool that will be successful primarily in the West, because that's where there's federal lands that are adjacent to urban areas that could be used. Looking at the East, that's not necessarily the case. It may have some opportunities, but not to the degree we're going to see in the West. And we have been told that housing affordability is an issue. So I have to assume as we move forward through these initial policy actions that are going on through the White House, that we're going to see all this at least bring more of a focus on housing, because it's what we're being told is it's not necessarily going to be housing specific. It's going to be affordability overall. So it will look at the cost of food, the cost of cars, all these different things, and housing will be part of that. We are hopeful that we're going to have more conversations with the White House on that and be able to move some sort of an agenda forward.
That's amazing. And just you mentioned the HUD voucher thing. As way of background, I'll just sort of say what I know is that if you accept HUD vouchers as a property owner, there's a long and painful process that you have to go through. It's often, I've been curious about that just because right now, I think HUD oversees that program. Am I correct? It's HUD that specifically administers that through local housing authorities. And so if there were to be changes to that program, is that a legislative type of change, or is it through HUD, or where does that happen, out of curiosity?
Some of it's legislative, like, for example, the inspection program, that the inspection that has to occur, that is mandated through federal law. And so that is really tied the hands of HUD to be able to make reforms in this area because it's something that an act of Congress needs to allow for more flexibility. There's also the public housing authorities, and there's three different lobbying groups that they have, depending, and what I've told, it breaks out roughly on the size of the authorities. And so there are some authorities that are doing a great job and really making changes that are innovative, and there's others that are not. And so that is another challenge as well, is that if it was more like a fast food enterprise, McDonald's, Burger King, name the fast food franchise, what they strive for is that the customer is going to have the same experience everywhere they go. That is not the case with the Section 8 program. And also, it is very much focused on the residents as the customers and not the property owners that are providing those units as the customers. And they really have two customers here. They have the people who are receiving the vouchers, and they have the operators that are providing the housing units for these voucher holders to move into. So there's some fundamental changes here that could occur that I think would be very beneficial.
You've mentioned a few things that really pique my interest, like who is the customer is kind of a classic technology innovation product manager type question when you're designing solutions. But you've also mentioned a lot of things like TSA PreCheck and Clear, where it was actually data, the use of data and technology that brought a lot of those efficiencies to bear. Where are you seeing, if you're seeing private startup or entrepreneurs or technology providers either partnering with your members, partnering with you, or showing the providers of this housing that these opportunities are out there? Are you optimistic that that is actually going on and is a solution, or are we at the very early stages of that and we need more entrepreneurs looking at this problem?
I think we need more entrepreneurs looking at this problem. There is capital that is chasing it, but also they need to have an understanding of the industry itself. And so it's going to be that marrying up of entrepreneurial spirit and drive with understanding the industry and the capital to be able to move forward. I think that's going to, from the standpoint of citing new development locations and where people are going to build, that's going to be an issue. From the standpoint of the operation of assets and working with, or it's more sort of an education process, working with the owners of the assets, as well as those that are managing the assets, to be able to have them understand what's going forward and what's going to be the best long term. I think that this is an industry, real estate in general. If you're entrepreneurial, it's involved in the acquiring of the asset. But that tech savvy is not necessarily something that's ingrained in real estate at this point, and that's something that has to happen over time to be able to embrace changes and move forward. Previous to COVID, there had been a very long positive stretch for the industry, and tech companies were trying to get into the industry and break in on the operations side. And the attitude of the ownership was, it's not broken, so why do I want to fix it? Then COVID happened, and then online leasing and all the other things began to move forward, and we began to see this acceleration. And there were some internal conversations that I was a party to, where people were discussing, is this pace going to continue? And of course, they didn't want to continue to spend the dollars, but then when you look at the cost of labor as it rises over time, along with your other costs that are increasing, you can't afford not to embrace technology because you have to be as efficient as you possibly can. Otherwise, you get to a point where the institutional investors are looking to other places where they're going to have higher and better returns.
Yeah, I mean, we certainly have experiences with this at Built, just becoming the payment platform now at 5 million different units. But there was a long adoption curve to kind of get the industry comfortable with it. And I've spent a lot of time looking at where some of the other technology innovations have come. You mentioned sort of qualifying tenants and using more data to, be more effective and efficient. I've seen robotics companies doing vacuuming to lower the cost of labor, sort of maintaining properties. So, I mean, the list goes on and on. I'm curious, is there a specific area that you're most optimistic about that you're seeing that adoption curve really start to spike and trend upward in terms of technology adoption?
I think with regards to this, the continued challenges that we're having around identity theft and all the different things that people are facing in that area, I think this is an area that is ripe for technology to really play a critical tool in evaluating those people that are applying to make sure they are actually who they say they are, to ensure that you're not the victim of somebody moving in who has an agenda other than moving into the unit and living there, and they're going to take advantage of the situation. That is something that I think is evolving for those operators that have centralized their operations. They can measure things like fraud and identity theft. For those that have not centralized operations, it's difficult for them to measure this. And so, as we were talking before, the more we can get data to come into the equation, the easier it's going to be for those decisions to be made to move forward on technology, whether it's development, whether it is a marketing strategy around trying to get new residents into a new build or an existing unit that's being repositioned. It's all about data. And this is an industry that is still not at the point they should be from the standpoint of data, partially because it's a low margin industry. 93 cents of every dollar that's collected in rent goes back out, whether that is to pay the mortgage, to pay employees, to pay taxes, to pay insurance. All those go back out. And so this is an industry that hasn't invested in the IT or the data on the back end that they should. I think going forward, those operators that do not invest in this are going to be looking at challenges, just as you look at a C quality product in a B quality location for a reposition. I think technology is going to become part of that equation as well, where you're going to look at portfolios of properties that are not being managed to their highest and best use. And an acquisition and use of technology can have incredible rewards as a result of moving forward.
I think that's a great call to action because we do have a lot of innovators and founders who listen to Housing Insiders, and so that's exactly the type of thing that we may see. Like you said, you got to have some knowledge of who your customer is and what the industry is and is doing. But there sounds to be like a lot of opportunity there, and more overlap with fintech than I think many of our listeners might have assumed.
I'm curious, the other sort of fintech area, which I think is being called contech, construction technology. I've been, a big advocate for sort of this concept of industrialized construction. And one of the issues, I'm very curious to get your thoughts, and I'll kind of share a little bit about how I've been thinking about it. So, if you are building an industrialized construction plant, say in Kentucky, and you want to ship to create multifamily units in the West and the East or wherever, one immediate challenge you'll face is that the building codes are different even outside your front door and your back door. I mean, they're literally different everywhere you go. And in some ways, if you could nationalize building codes and make the creation of supply more consistent and easier, my guess is you're able to take advantage of these technologies, modular, panelized, so on and so forth, and lower the cost of construction. Now, I know land is always going to be the greatest input, and you've got financing, all these other components. But if you really want to tackle, making the construction itself cheaper through industrialized construction, you got to tackle building codes. So that I was happy to see that on your list of things that you're advocating for. What are your thoughts on that? What's the state of that conversation, out of curiosity?
Yeah, I mean, building codes is a key to really having that sort of centralized construction of rental units and then the distribution across the country. Everything is fuzzy. There's before COVID and after COVID. But about 10 years ago, there were a number of companies that received dollars to really begin to move forward in this area. And they had some success for a while, but weren't really successful. And then more recently, Greystar is pushing that LTD option out there, and they're looking at creating a construction site, but then they have a distribution zone that is a certain amount of miles around where the factory is, which goes to the cost of moving these products. I think that there's a lot of opportunity for innovation and technology to be able to look at how do we get to a point where we can have units constructed at a central location. They can be inspected on site for the various codes of where they're going to be going, and then be assembled once they get to the location they need to be. Granted, it's different for a garden versus a mid-rise versus a high-rise, and there's different ways of approaching that. But it's happening around the world in various locations. It's just a matter of we need to get out of the mindset that you're going to have we build housing in this country today the way cars were built in the last century, at the beginning of the last century, where you had a bespoke car that was built. We're essentially doing the same thing with housing in this country. And that is something that needs to stop. We need to go to more of an assembly line approach if we're ever going to solve this problem, to develop housing at the numbers we need to in the timelines we need to.
One thing that, being in Detroit and hearing you talk about cars brings to mind is that the auto industry uses this idea of the concept car. They put it out there before it's a real thing to get everybody excited at the auto show. Do you have a housing version of a concept car that you think would actually change legislators, policymakers, those local mayors? Is there something like that in housing that we could think about, or that our listeners could think about, that's like, this is the concept car that would maybe start changing some minds in local level?
That happens. There's various shows that really highlight all the innovative things that are going on and what is possible. And those shows are very industry inward focused and not consumer focused. I think the success of the car industry is that they understood a long time ago that they need the consumers to buy into what was going to be coming off of the assembly lines. And that is a leap that we have not made yet, but that is going to be necessary to move things forward. I mean, artificial intelligence, I went through a briefing where they were talking about the dawn of artificial intelligence in the 1940s and the stops and starts it had. And it wasn't until the consumer was engaged in artificial intelligence through our mobile phones and all the other things that we have that I think gives it the staying power it needs. And so that's the ultimate solution that we need going forward in creating more modular housing, is we need the consumer to value this type of product, and then the market's going to follow.
I agree. I mean, look, you're preaching the choir here. We've talked about this a lot. In fact, on an earlier episode, I mentioned that I was using AI to figure out how to create building codes that were more consistent. And AI is just an incredible tool to be able to analyze and assess and change building codes. So we have the ability. You mentioned earlier that this administration is focused on lowering costs across the board, which I think, is obviously the right approach overall. But I think it's a real miss not to put housing sort of on the top of the list and have a cohesive view of how we open up federal lands and improve incentives and financing for new homes and leverage nationalized building codes to really accelerate the development of new things, because it should be sexy and exciting as like a new Mercedes would be, or I shouldn't say Mercedes, maybe a new Ford. Sorry, Jeremy. But I think that area of technology can really progress rapidly if it has the ability to create a product that could be consistent and not have to change every 10 miles that it goes.
That is completely true. And I think that housing was an issue in the last election cycle to a degree I've never seen before at the presidential level where it's being discussed. That being said, there's a lot of other things that are going on right now geopolitically, but housing is something that needs to be addressed. When we were having a briefing with congressional staff, I was highlighting to them the current state of the rental market, where we have this excess supply that is being absorbed in 2025. Largely in 2026, we're going to begin to see rent increases again because we're going to have that excess supply absorbed. And what I was trying to bring home for them is this is going to become an issue again during your reelection for those of you on the House side. And so the midterm elections being so important to the Republican leadership right now suggests that we do have some leverage or some angles to get housing into the conversation much more than it's ever been before, to hopefully get some solutions that are going to be lasting. because I'm looking for a solution that is going to be for the next 10, 15, 20 years, not for the next 2 years, not for the next 3 years.
Yes, thank you so much for that optimism. I agree, and I look forward to working on that. So thank you, Bob, for joining us today. I think that does it for this episode. We'd love to hear from you. Send us an email, your thoughts, your comments, podcast at thehousinginsiders.com. And if you like what you hear, please leave us a review.
Yeah, likewise. Thank you so much, Bob, for being with us today. Really great to see you. And yeah, encourage everyone to hit subscribe for more episodes in your feed.